You ever have this feeling you do everything right for retirement? You save, you invest, you finally get close to the finish line, and then someone casually says, "Hey, you know the tax rules are changing after 2025, right?" And suddenly you're thinking, wait, did I just plan my entire retirement using numbers that expire in a year or two? If you're planning to retire in the next couple of years, there's one quiet tax rule change that could mean the same income and the same lifestyle, but a bigger slice going to the IRS once the calendar flips to 2026. Most people haven't looked at it. Most advisors don't explain it clearly. So in this video, I want to walk you through what's actually happening with the 2026 tax changes, how it could affect your retirement income, and a few calm, practical things to start thinking about now so you're not surprised later. If we haven't met before, this channel is all about building a freedom salary in retirement, a steady, sustainable income that lets you live your life without obsessing over markets, headlines, or the latest financial panic. I want to say this up front. If you've heard about the 2026 tax cliff and your first reaction was, "I have no idea what that means, but it sounds bad," you're not alone. Most people feel a little embarrassed saying, "I don't really understand how tax brackets work now, so how am I supposed to understand what happens in 2026? There is zero shame in that. You are not a tax professional. You've been busy working, raising families, living life. The important thing is not to know every line of the tax code. The important thing is to understand the big picture well enough to make calm, clear decisions. So let's do that together, step by step in plain English. Here's the invisible mechanism that most people miss. It's not that the IRS suddenly invents a new tax in 2026. What's happening is more subtle. The temporary tax rules we've been living under since the big tax law change a few years ago are scheduled to end after December 31st, 2025. And if nothing changes in Congress, we go back to an older set of rules in 2026. Same you, same retirement accounts, same Social Security, but the toll booth you drive through, the tax brackets and deductions, quietly shift shape. Think of it like this. Imagine you've been driving a familiar highway to work for years. The toll is $2, the booths are wide, the lanes are clear. You budget your commute around that. Then one day, the highway goes back to its older design. The toll booths are a little narrower, the toll itself is higher, and there are a few more cars squeezed into the same space. You're still driving to the same job, but it costs a little more and feels a bit more crowded. That's essentially what can happen to retirees in 2026. Not because they did anything wrong, but because the toll booth, the tax rules, quietly shift around them. Let me bring this down to earth with a simple example. Meet Bob and Sue. They're both in their early 60s. They've worked hard, saved consistently, and they're thinking about retiring sometime between now and 2026. Their rough plan looks like this. They'll each claim Social Security at different times. They have a good-sized traditional 401k and IRA. They want about $80,000 a year to live on after tax. Bob says, "We're not trying to be fancy. We just want to know if we retire before 2026, will we be okay? Or are these tax changes going to mess everything up?" Here's the key part of their situation. Right now, under today's rules, their income plan, Social Security plus withdrawal from their retirement accounts, fits fairly comfortably in their current tax bracket with the larger standard deduction we've been enjoying. Translation in plain English, they pay tax, but not as much as they expected, and it feels manageable. But when we look out beyond 2025, something interesting happens. We run the same basic lifestyle through a 2026 lens, same $80,000 goal, same Social Security, same IRA withdrawals, and we see that their tax brackets are a bit steeper. The standard deduction shrinks. The thresholds where higher tax rates kick in move down. Nothing dramatic, no flashing red lights, but enough that more of their income could be exposed to higher tax rates for the exact same lifestyle. Bob's reaction is, "So we're not doomed, but if we ignore this, we might end up tipping more to the IRS than we need to." Exactly. Once they understood that, the anxiety shifted. It went from, "Is this some giant scary thing we can't control?" to, "Oh, this is just something we should plan around calmly while we still have time." That's the mindset shift I want for you as well. Let's walk through the core ideas in very simple terms. Again, this is not tax advice and it's no substitute for working with a qualified professional, but these are the big picture shifts worth understanding. Insight number 1. The rules we have now are on sale through 2025. Right now, many households benefit from generally lower tax rates on ordinary income and a larger standard deduction.
In 2026, if current law doesn't change, we're scheduled to go back to older, somewhat higher tax rates and a smaller standard deduction. For retirees, the main effect isn't some exotic new tax. It's simply that your withdrawals from traditional IRAs and 401ks may simply bump into higher rates sooner than they do today. Insight number 2, same lifestyle, different tax bill is the real risk. A lot of people think, I'm retired, my income is fixed, so my taxes shouldn't really change, right? But if you're planning to retire around 2025, your fixed income might be crossing from one tax world to another. In today's world, your numbers might fit neatly into a friendly bracket. In 2026, those same numbers might land slightly higher up the ladder. Insight number 3, timing and flexibility matter more than precision. Here's the good news. You don't need a perfectly optimized plan. You simply need to recognize that you have a window between now and the end of 2025. That awareness gives you the chance to ask, does it make sense to adjust when I retire? Or are there any moves like Roth conversions that might make more sense before 2026 than after? So what can you actually do? Here are a few calm, practical steps you can consider. First, get a two-scenario view. Instead of planning your retirement using just today's rules, ask what does our retirement income look like under today's tax brackets and the projected 2026 rules. Even a simple estimate gives you visibility. Second, think in terms of before 2026 versus after 2026. If you're planning to retire soon, ask, are there any years where our income might be lower and therefore more flexible? Sometimes the early retirement years offer more room to make tax-smart choices. Third, talk to a professional specifically about the 2026 tax changes. When you meet with a planner or tax pro, be direct. Ask, can we walk through how the scheduled 2026 tax changes might affect our retirement income plan? And if someone tries to use this as a scare tactic or pressures you into a do this right now or you're doomed strategy, that's a red flag. The right advisor will help you explore options calmly, not sell you fear. If this brought a little clarity, tap like to support the channel. And if you enjoy calm, no-hype explanations, explore the other videos here and consider subscribing for weekly uploads. Let me leave you with this. The 2026 tax changes are not a reason to panic. They're simply a reminder that the rules move and your retirement plan should be allowed to move with them. You've spent decades building what you have. You deserve a retirement that isn't ruled by fear of headlines. Take a breath. Give yourself credit for caring enough to learn this. And remember, retirement isn't about outsmarting every detail of the tax code. It's about having enough clarity to make decisions that feel peaceful. You've got this. Thanks for watching.